Welcome to Subramani. I'm going to talk to you about some more axioms in the market and tell you that does not mean that you will make money in the market. So let us take the first one, which all of us have heard, whether it is Buffett or Peter Lynch or John Templeton. All three Americans have said in the past is in the long run you will markets equity will do well. I agree with that. In the long run, equity will do well. But remember, you could be invested in Taiwan and China could do well. You could be invested in Japan and China could do well. You could be invested in India and US could do well. All of that, which means in the long run, market equity is making money, but you may not be in that particular market. That can happen. You may be invested in mid caps and large caps could do well, right? So you should worry about markets only when you are in the markets exactly like the market. For example, people ask where is the Sensex or where is the Nifty today. It doesn't really matter because most portfolios do not reflect the market. You just picked up some random shares which could do better than the index, maybe worse than the index. Your portfolio could do anything. But remember, all these axioms saying in the long run equities will do well is right. But that does not mean in the long run in equities you will make money unless you have built a good portfolio of good companies and waited in the long run, and you are not going to be concerned too much about whether French markets are doing well or whether US markets are doing well. You have invested in Indian markets, maybe in the index, maybe some large caps, some mid caps, some flexi cap kind of a fund. You have to be clear whether that fund is doing well in the period of time that you are invested. So over 5 years, 10 years, 20 years, 50 years, the company, the places which you have invested, the country in which you have invested could make money. But if your time frame is 1 year, 2 year, 3 year, 4 years, you may not have made money, right? So understand that it's very important to know that equities will make money in the long run. But when we say equities, we mean the world markets, right? Not just one market. For example, for whatever reasons, if the American president decides, of course he will not be allowed to, that arms are not a great way to improve the world, then the American GDP could take a hit because a huge part of the American GDP is made out of arms and ammunition, right? So you have to be clear that in the long run, equity markets will make money is something which most American scholars have said, right? Or you have not heard a Russian saying, oh, I invested in the Russian market in 1908 and in 1917 the markets closed down. It just shut down. Then what happens, right? So the only assets that you have is financial assets, and financial markets close down. What happens? We don't have an answer to that, but it has happened in the past. So you have to be worried about such things which can happen. So yes, money equity does well in the long run, but it does not mean you will make money in the in that market because you are not in that particular market. In the short run, you could get completely killed by by what is happening in the market simply because your reading of the market for the short run may be wrong, and the markets could decide something differently. For example, in 2024, if you had decided that you will be bullish, but if the results, election results in India and US and all are very different from what the market is predicting, the market to take a hit. So it might take 2 years for the market to recover, but then you, in the short run, you are going to be just smoked out of the market, and that could really hurt. So in the short run, markets could do whatever it wants. You could wipe out 50% of your net worth. It shouldn't matter, because if you know that in the long run it is going to make money, you have to have other sources of income. You have to have maybe dependent on dividend income, salary income, rental income, something which should not bother you too much about the fact that a portion of your equity portfolio has been wiped out. So if you are a person who is very scared of putting money in equities, then be careful, don't put too much. Some of us would have 90% in equities, knowing fully well once in a lifetime we may lose 50% of the of our portfolio, but does not bother us, right? So that's important for you to know that in the short run you could get smoked out and you could get hurt really bad. And another thing is, what is the average return to expect? I do not know why, but most people answer this question as 12 to 15%. It's not your right to get 12 to 15%. I don't know from where you get that number. And also, this 12 to 15% is not a PPF kind of a return that 7 to 7.25 is where it will fluctuate. No, 12 to 15% may be possible over 5 years, 10 years, 20 years. I'm not even getting into the numbers, but that 12 will not mean 12 to 15. 1 year you will get 32%, next year you will get 0%. Right, so you will still fall within the range even for 2 years, but you will definitely fall within the range only for 10 or 15 years, and after that, if you don't fall in that range, then the range changes. You cannot argue with the facts that this is the return that you have got. What about wiping out 50% of your equity portfolio? Not impossible, but pretty unlikely today, because all over the world, the Fed or the RBI or the government of India, nobody wants to see such a long and deep fall, right? So they will do something to protect, so don't worry too much about that portion, right? So, but one thing is, you will never get anything between, let's say if it is 14% is average which you are expecting, expect 0, expect 28, expect 32, except -3. These are the numbers which you are going to see in the long run. The average 14, you may never see it, right? But the average could be 14. So remember that if you plot these returns of equity on a chart, it's going to be very confusing. So don't expect there to get 14 ever, but average could be 14, or average could be 12, average could be 9. I'm not saying how much the average would be, I'm just saying that the numbers would fluctuate dramatically in your total return. Another thing which people have to understand and accept is, when I take my, say, 40-year investment journey, all my returns could have come from 10-12 companies, and the other companies would have just been a drag on the portfolio. It could come from one geography. All the companies which could be headquartered in Bombay, or in my case it is headquartered in Bombay, Chennai, Bangalore. That's it. I have not made money from companies in Delhi, and here I exclude MNCs, because an MNC like ITC could be located in Calcutta, an MNC like Nestle could be located in Delhi. It doesn't really matter. MNCs don't have too much of a choice. I don't think ITC can shift out of Calcutta so easily, right? Politically not possible. So other than that, when it is Indian promoters, I have got an extreme bias towards Mumbai, Bangalore and Chennai. I don't look very favorably with companies from, say, even Ahmedabad or Delhi or Hyderabad. Hyderabad is a complete no-no. So what happens when you look at your portfolio, you realize that, oh, you've invested in about 100 companies, you got out of them, so you're stuck with, or you now hold 30-40 companies, maybe 60 companies, but all your returns have come from 10-15 companies over the years. This is very scary. And also over 40 years, that would be some 5 years, and you made a sensational return. In 6-7 years, you made good returns, and in some 15 years, you made bad returns. So on an average, you have outperformed the index. That's good. So that is how you look at it. Don't say every year on year I should get, and companies from Bombay and companies from Chennai and companies from Delhi is a good diversification. All that may be true, but all your returns could be concentrated in over periods of time from groups, from certain, all your money could have been made from IT companies for a period of time, from some other, from automobiles for last 1 year. Automobiles have been on a fantastic run, right? So all these kind of things could happen. So don't expect anything called average. On an average, what will happen? On an average does not make any sense, because the standard deviation is too high. So the asymmetric upside on parts of the portfolio is a fact. Accept that as a fact, right? So some of the basics: earnings drive stock prices. You cannot deny that. If there is good earning, there will be good stock prices. I'll continue it in the next one. Thank you.